Test, test.
Smaller and smaller by the week.
Yeah, we're
There's room, right?
Okay, Zoom crew, we're gonna go ahead and get started. I trust that you have audio and video. Somebody give me a thumbs up or chime in if you can't hear me. I'm gonna go ahead and get on with it. So tonight I'm going to be lecturing over Module 11, which is a shift. And Module 11 might be the easiest module all semester. So great, good news. The shift is from accounting to finance. We started out the semester talking a little bit about corporate strategy, about corporate side courses and SWOT analysis, a few of those types of conversations. And then we very quickly moved into the accounting world, talked about accounting for taxes and leases and inventory and reconciliation adjustments and recasting the financial statements and adjusting for goodwill impairments and discontinued operations. And we did 10 weeks of that. And I hope that it was a challenge because some of that accounting can be pretty technical. Tonight, we're going to shift gears a little bit and then begin to talk about finance and forecasting the financial statements, which is the first step to discounted cash flow. So we're starting to put it all together. Theoretically, at this point in the semester, you've been following along and you have identified the historical financial statements and are somewhat somewhat-ish familiar with maybe some reconciliations or adjustments that you might have to make to compare apples to apples when you're looking at competitors, or to compare apples to apples when you're trying to present or project what's going to happen with this company in the future. So we're going to talk about how we forecast those financial statements tonight. But before I launch in, hit me with any questions, homework, research report. Last time we were in class, I shared with you all a prompt that I had created over Claude, and I did get ADM to successfully run. Did you by chance try to do it on your own? I have not. But, okay, try to do it yourself, but I was also able to run it, so I'll share that file with you too. Pretty good, very robust. It has a breakdown of every module that we've covered during the semester with all the parameters that you need for a discounted cash flow analysis. You'll be able to just go back and forth between that report, the way that I want you to plug it into the templates. It's amazing what AI can do. I really do think it's incumbent upon all of us to know how to use it. What that means for the future of the industry or our jobs, I don't. But we need to know how to use it, because I guarantee your peers are going to know how to use it. And I don't think it's fair for you to leave this class or the law school at a disadvantage. Other questions? Good. If you think of something while we are going through module 11, just stop me. Just stop me. Oh, thank you. You got another one coming here. Okay. Okay, and just like with everything else in class, I have a tendency to approach all of these conversations from the perspective of a stock analyst. But our authors are very good about pointing out that there's a lot of other use cases for forecasting financial statements. And if you find yourself working for a corporate finance department, you're going to have to forecast your own internal financials in the future. I work for an advisory firm. We have a loan outstanding from the bank. Every quarter, the bank wants to see our financials along with an updated formula. So they share that with the bank. So the bank is a user, internal finance departments are a user, mergers and acquisition teams are users. 20 years ago, more than that now, gosh, 27 years ago, I worked for Sprint PCS, it was their global phone company, they had two tickers, that traded, one just tracked the mobile division. And we kept internal financial forecasts for Sprint and all of its competitors. And that was our best estimate of what we thought our competition was gonna be able to do in the future based on how they were investing in their sales force and their network and their marketing strategies and so on and so forth. So there's a lot of different use cases associated with forecasting financial statements. You'll need to know how to do it if you go into just the industry of finance. So let's make note of that before we move on and focus on the rest of the module as if we were working for a mutual fund. So I mentioned just a moment ago that we're working with adjusted financial statements, and our primary task all semester long has been right here in blue to identify and eliminate transitory items or other items that need to be adjusted. So if we've had a change in the accounting, or if we're using any accounting forecast or estimate that we don't think is a proper representation of the true underlying economic reality, we've just been changing it. And that's what financial analysts do. You look at the accounting, we understand the accounting, and then we say, nope, well, I don't think that's the one that they should use. I'm going to change it for my own internal purposes. Now, accountants can't do that. Accountants are called to the gap, and they have to get their marching orders from the CFO and CEO and management team. So then they have to produce these accounting statements in accordance with GAAP. But as financial analysts, we can take a lot of flexibility with how we want to see the numbers, and that's dependent upon what we're using them for. So step number one is to eliminate those transitory items or anything that we don't think is going to repeat in the future. And then to recast, you've heard me use the term recast, reformulate, or scrubbing those numbers to best represent the estimates. And really, we're just trying to create a clean version of the financial statements, something that we believe in, the truest representation, if you will. So to forecast the financial statements, we're going to start with the income statement. And I say this is perhaps the easiest module that we'll look at all semester. And I hope that's true. I really hope that's true. Because when we look at the income statement, when we look at the balance sheet, when we look at the cash flow statement, we're really just trying to think about how much money is this company going to make next year? What are their financial statements going to look like next year? And that's one of the reasons why I had you all select from a list of dividend aristocrats, because they have a very long track record that really, really helps this process. So when you're looking at a company like Tate, or when you're looking at a company like General Motors, or when you're looking at a company like Smuckers or Campbell's Soup, their growth rate is about 3 or 4% and has been for 50 years. That makes it relatively easy to forecast what their sales are probably going to be next year. And these companies are so big, so well respected, and have such large investor relations departments, they're going to tell you what they think their revenues are going to be. So this is an easier project than it might seem like on the surface. So we're going to start with the income statement. Obviously, the top line of the income statement is sales. So we're going to begin there. This forecasting process has a couple of, well, I guess on slide 7 here, you just call it a couple of checkpoints or green flags that we look for, or pink flags that we look for. So internal consistency. One of the reasons we go through this forecasting process and do all of the financial statements is to check for internal consistency. That's how we know that we're doing a good job when we forecast the financial statement. So when I'm doing this in practice, I rarely go beyond the income statement. but for the sake of this class and for the sake of understanding with the financials, we're gonna forecast all three major financial statements, the income statement, the balance sheet, and the statement of cash flows. And once we've done that, we're gonna see that they articulate. We're gonna see that the net income from the income statement flows through to the balance sheet, increases the cash balance on the balance sheet, and then you're gonna have a choice. What do you do with that cash? Is it the company's strategy to pay down debt? Is it the company's strategy to reinvest that cash in sales and marketing? Is it the company's strategy to deploy that cash or distribute that cash in the form of a dividend? All of those questions need to be represented by the financial statements, and when you see that they're congruent with one another, the accountants call that articulating. The last bullet on the slide is level of precision. Don't get your mind all wrapped around the axle when it comes to forecasting financial statements. It's not as hard as it seems. And I'm hopeful that the example we'll go through tonight of Procter & Gamble will give kind of a line by line suggested way to forecast this thing. But we don't need to get it right to the second decimal point. We just need to get it right close. We're just ballpark correct here. I like to say in the world of finance, we're not looking for accuracy to the second decimal point like we are. If we get it up or down, we win. So that's the level of accuracy that we're really shooting for here. I'm hopeful that'll be apparent. Okay, this is what you're looking for to start this whole process. There's a template on Canvas associated with this project. It has the core of a discounted cash flow. So it has current year, the next 10 years. Let me just pull it up. Be easier if I just pull it up. Okay. Research project template. This template's dated 2021, so it's a little old. I need to refresh it, but there you go. So this is an Excel file. This is gonna, if you click on that template, it's gonna pull up. And I've pre-populated the major components of a discounted cash flow analysis. So you'll see that it begins with revenue and the growth rate of revenue. And this is a very, very simple discounted cash. I want you to add to this as you see appropriate. So if you want to include a cost of goods sold, or you want to include more detail around selling, general, or administrative expenses, or any other line item that your company management team has given forecast for, feel free to include it. You don't have to. Towards the end of the semester, towards the end of this module, our authors will refer to this as the parsimonious method. And it's just a very, very simple way to forecast revenues and earnings in the future. So we begin with revenue, and I have a growth rate in here. This is based on historical growth. So you're probably going to see 3 or 4% in that cell right there, driving future revenues. And then I have an EBIT margin, earnings before interest and tax. So that's our you can think of that as our operating margin. And when I say operating margin, I really want you to key in on the notion that those are the cash flows that are going to come from future operations. So we've already excluded any one-time event. We've excluded any discontinued operations. We've excluded any restructurings. None of those things will continue in the future, at least that's the theory. Management presents them that way. That's very, very common. So if you can look back at historical EBIT margin, then it's really just an exercise of, can this company maintain what it's done historically? Or maybe the last few years you've been in a cyclical low or recession, we haven't been, but maybe there's some other reason why the company you're looking at has had low margins for the last couple of years. And if that's the case, then management was probably alluded to that. And you'll be able to say, well, historical EBIT margin has been 6%, but I think over the next few years, they're gonna be able to raise that from 6%, 7% to 8% to 9%. In which case, this line right here gives you the ability to plug those margins in. And when you have EBIT margin times revenue, well, you have EBIT. Then you're just missing interest. We'll talk about how to forecast interest. Pre-tax earnings, then we need to forecast tax. We'll talk about tax. Net income, earnings per share, and everything else in this spreadsheet just flows on down into a discounted cash flow analysis. And we'll talk about the remaining components of this as we work our way through the lecture tonight. But just stop me at any point during these examples and we can add some clarifying points. But that Excel file is out there for you to use, and it's pretty simple in form, and that's by design, and that is a great place to start. So P&G, here's an example of the type of forecast that they give to the street. So they're giving their analysts organic sales growth of 3 to 5% and all-in sales growth of 0 to 2%. I don't really know what that means. Their all-in sales growth is less than their organic sales growth. So there's something in there that's detracting from sales that's not organic. And here it is right here. P&G also anticipates a negative 3% currency exchange rate. So that could decline from sales. All-in sales growth estimate of 0 to 2 is 3 percentage points lower than the estimate of organic. Okay. And then they forecast a 1% expected growth rate for sales, the midpoint of the 0 to 2% range. All of you should have something similar to this if you've gone to the investor relations site for the company that you're doing research on. Is everybody good out to IR by this point? When I say IR, I mean investor relations. Got the, okay, I see a lot of thumbs up. That's good, good, and good. I like to hear that. Management further forecasts an adjusted free cash flow productivity of 90%. I don't know what adjusted free cash flow productivity means. That's not a GAAP measure. And anytime it's not a GAAP measure, you're going to have to look to the management team to define it. I can take a guess. It's something that looks a lot like EBITDA with adjustments for depreciation. Maybe you're swapping in CapEx, but that would be defined. Capital spending quoted here as a percentage of sales. It's approximately 5%. That's a very common way to forecast capital expenditures as a percentage of sales. If management doesn't quote it like that, then calculate it yourself. Go back and look at the history of your company's sales. Go back and look at the history of your company's capital expenditures. Calculate what percentage those capital expenditures are of sales for the last 4 or 5 years and see if you can discern any patterns. If it's been 5% every year for the last decade, bingo, you don't have to look any farther. It's 5% is your forecast number for 2027. Dividends, those are given to us. Direct share repurchase, those are given to us. Now, in most cases, you're going to be able to use the numbers that management suggests. Every once in a while, you're going to find something within the accounting or your historical analysis of the way management's been running the company, or just a formulated opinion on where you think the economy is going to go. And it's going to cause you to call BS, I guess, on the management. You know, maybe their forecasts are a little bit too rosy. And that's great. We're trying to develop the talent that will give all of you the skill set to call BS on the management. Because that's where the real opportunity is. When you can see through their forecasts to what's really going on in the economy and say, no, I don't agree with management, they're being too aggressive here. That's where you have the opportunity to make money as an investor. Because if their forecasts are spot on, everybody in the world of investing knows it. And when everybody in the world of investing knows something, there's no opportunity to profit. We call that an efficient market hypothesis. It's only when we as a community of analysts can put on our stock analyst hats and see through something like this and find something that the rest of Wall Street or the rest of the investing community has yet to realize where the real opportunity lies. And you'll hear finance wonks like myself refer to that as a variant opinion. When you can create or when you can support a variant opinion, you have real opportunity to make some money in the market. Okay, page number 11. Okay, now we're just going to go through line item by line item down the income statement and talk about how we would forecast Procter & Gamble. Oh, that's great. Yeah, I would encourage you to do that. It takes a lot of work because you have to. I haven't seen a service anywhere that will do that for you. So you have to go back and click on the forecast, like you have to dig up the. It's 2026 now, so you probably have to go back to 2024 and look at the investor relations guidance and put that into a spreadsheet, and then you have to dig up the actual numbers and put that into a spreadsheet and calculate the difference. And if you did that for 2023, 22, 21, you went back 10 years, it'd be a great exercise to go through because now you have everything you need to assess the competence of the investor relations department. And that's going to inform you on how confident you can be in the work. There is something that I've seen. There's a tool out there, and I think you can access it on FactSet, and it's another. It's not the same thing, but I was thinking about it, trying to answer your question, so I'll just share. I think it's called I think it's Black something. Anyway, you can find it on FactSet, if memory serves, underneath the SEC filings section. And these are SEC filings that have been redlined by looking at year over year or quarter over quarter statements. So what this service does is it'll take an annual report, 10K, and it'll overlay it on top of the prior year. And all the language that is identical, they'll print in black. And all the language that is changed, they'll print in red. And there's a website that I used to like to frequent called footnoted.org. It's a pay site now, so I don't go out there anymore. But the gal that launched it originally is an incredible accountant. And she was the first one to tip me off on this. But when you look at the SEC filings year over year, and you identify the language that has changed, she would recommend going through and counting the phrases, quote, change in control, end quote. Okay. She correlated that to, if you see a big spike in that term, change in control, what you're observing is a management team posturing themselves for a sale of the company. And she would invest based on companies that have this change in their SEC filing. And lo and behold, she would harvest for those premiums associated with big sales in the market because it's exactly like you think. Management knows that they're posturing themselves to change the company. And if they are posturing themselves to change the company, they probably want to change all the legalese associated with the perks and vesting schedules and everything else that will accrue to them upon change in control of the business. So it's another subtle way that she was able to identify posturing or management positioning themselves to get themselves paid. It's just another subtle little form of follow the pay. But I love that suggestion. Okay, let's talk sales growth. On this slide here, what we're looking at is Procter and Gamble. They already told us sales growth was going to be 1%. But then they walk us through all of the expense estimates and how they're being forecast. So cost of goods sold and selling, general and administrative expense is being forecast as 8% of sales. So that's super easy. Yeah. Okay, so cost of goods sold has varied at 6% of sales, or it's probably a little higher, probably 12 or 15% of sales for the last 8 or 10 years. That's a pretty good way to forecast the next year's cost of goods sold. Same way with SG&A expense. Depreciation expense, we're gonna take the beginning of year property, plant, and equipment times the estimated depreciation rate. How do we find the estimated depreciation rate?
That, handicap based on what it is, and then the, IRS table, the IRS table for that particular rent.
Yes, that's more work than I want you to do, but yes, and yes, we might have been given that number by management. The simplest way is just to look at last year. We know what the depreciation was last year, and we know what the beginning property, plant, and equipment was last year. Let's just calculate that ratio. What percentage of property, plant, and equipment was depreciation last year? And then we can just use that rate times this year's beginning balance of property, plant, and equipment. Interest expense ought to be easy. We know the average interest bearing debt, again, from last year. We know how much interest expense was last year. We know how much debt we had on our balance sheet last year. Interest divided by debt equals interest rate times the beginning debt balance this year equals expected or forecasted interest expense. Non-operating expenses, generally, we're going to assume no change, or maybe we'll adjust those later, but for the purposes of this class, just assume no change unless you have reason to believe they'll change, and that's either going to be a forecast from the management team or they've steadily been declining over the last 5 or 6 years. One-time items, again, those are transitory, so we're going to factor all those out, so the forecast would be 0. Other non-operating expenses, just use a 5-year average. Usually those other non-operating expenses fall underneath that broad category that we were talking about, which is precision. By the time you get down to this spot on the income statement, you're usually not talking about line items that are going to affect your discounted cash flow. What will affect your discounted cash flow? Top line growth rate, margin. You got to be really sharp on the margins, and then we're talking about weighted average cost of capital and growth rate into perpetuity. And I'm going to show you another slide here in a few minutes about how we'll do some sensitivity analysis around your key inputs. Other non-operating expenses, not the key input. So let's use a 5-year average or something that makes your life a little easier there. Here's your cheat sheet. So star this after tonight's lecture. If you need to come back for a homework question or test question, you'll have this readily available. But you can see top line, net sales, start with last year's sales, multiply that times the growth rate, and then you have a little explanation there. We just went through every one of those. This is just a nice slide to dog ear or star to be able to come back and understand the rationale that went into all this. I want you to have a similar table pulled together for your research report. I want you to be able to communicate to me where your assumptions have come from. And if you've taken them all from management guidance, great. say a little something nice about the management team. Tell me why you believe they do a pretty good job of giving guidance, and that's fine. Bring it to my attention if you have differed from the management team in any way, shape, or form. Here's an example of P&G company guidance. So they've given us sales, cost of products, and here's their commentary. I won't read it to you, but they break it down by basis points, and they give you some sub bullets about why they believe those margins are going to improve over the next few years. Talk about change in costs, commodities, input prices. They talked about their currency fluctuations on the prior slide. You need to familiarize yourself with everything that's going into those subtle little fluctuations, because you usually only get the guidance a year, maybe 2 years out. And I'm going to ask you to pull together a forecast that goes 10 years out. So you're identifying a year out would be 2027. 2028 is usually a continuation of 2027, and you're using a lot of these bullet points to make that forecast. And then anything beyond 2 years is really just an iteration or a straight line forecast between time A being your short term and where you think this company is going to end up at maturity or in perpetuity. So we'll talk a little bit more about that here in a minute. I have an example for you. SG&A, same comments here. Procter & Gamble does a nice job of giving you some detail behind their selling, general, and administrative expenses. So look for that in your IR materials. We talked about interest, and I don't have any new comments on this slide. Our authors are just walking us through the calculation for Procter & Gamble, but we're taking last year's interest expense divided by debt outstanding and applying that interest rate onto the beginning balance of debt this year. Income tax expense is similar. You'll recall from our income tax module that there's a table in the back of your 10K that's going to look something like this, and it's going to produce an effective tax rate. If you have your earnings before interest and taxes, well, the last slide was interest. Below interest is taxes, so we're going to multiply our earnings before taxes times this effective tax rate. It's your job as the analyst to understand everything that goes into this table, so you can make any adjustments if you need to make any adjustments. So I don't know Procter & Gamble well enough to say that the tax benefit from simplification of legal entity structure is likely to recur. For the sake of this project, it's okay if you just assume the effective tax rate is going to be consistent with this table. But in practice, you would have done a deep enough analysis to come to your own conclusion about whether or not every single one of those was likely to repeat. But that's a little bit beyond the scope of this class, because changes in certain tax policies, that's just a lot more work than what we're after for this project. Be mindful of and be careful of the impact of acquisitions. Our authors give us the example of Procter & Gamble, and in 2005, I guess, can't believe it's been that long. In 2005, Procter & Gamble bought Gillette, and it was a huge merger, $30 billion apparently. So anyway, if you just looked at Procter & Gamble's financial statements, the year after they made that purchase, the growth rate would have looked like 20%. And Procter & Gamble was Procter & Gamble. Band-Aids and Ensure nutrition drinks and everything boring that you see when you go into the grocery store. They're not growing at 20%. So the rookie analyst would see that and maybe come to the wrong conclusion that this company can grow at 20%. No, Procter & Gamble can't grow at 20%. They bought Gillette, and that's why you see a big spike in their growth year over year. You have to reconcile for them. They're going to be growing at 3% if they're lucky next year and the year after that. They just told us 4 slides ago they expect their growth rate to be 1% this year. So be mindful for acquisitions that inflate growth numbers, and be mindful for divestitures that artificially lower growth rates. In both instances, your companies will be required to publish pro forma financials that reconcile for those acquisitions. And those pro forma financials are going to look something like this. So when we reconcile for that acquisition, we see net sales of 61 billion, 67 billion, and 71 billion, and net sales growth of 4.5%. Now that's a number that we can use. Those two companies combined really did 4.5% year-over-year sales. Probably a pretty good place to start when we're thinking about what they would have done in, I guess next year we're going to 2007. Impact of divestitures, I just mentioned that same story. Look for the pro formas. Okay, let's move on to the balance sheet. Balance sheet is a little bit more complicated because of the income statement simplicity. Almost everything on the income statement was linked to sales, with a few exceptions: interest expense, tax expense, but even those still pretty simple. Balance sheet, you really have to go through line item by line item and ask yourself, okay, what is this? And what do I link it to? How do I forecast this? What's it likely to be next year? And what do we start with on the balance sheet? First line on the balance sheet, first asset class is what? Cash. How do you forecast cash? Trick question. You don't forecast cash. You leave cash empty until you forecast everything else on the balance sheet, and then cash is just deployed. So balance sheet has to balance. Cash is what you have left over after you forecast everything else on the balance sheet. So all the assets, all the liabilities, working capital, so on and so forth. You'll fill all those in, and then cash will make the whole thing balance. So let's talk about working capital. So we have working capital, you'll remember, is short-term assets, short-term liabilities. These are accounts receivable, or payable, or inventory, so on and so forth. That varies as a percentage of sales, which, think about those accounts. Your inventory, of course, that's going to vary with sales. Your accounts receivable, of course, that's going to vary with sales. Your accounts payable, of course, that's going to vary with sales. So we've just knocked out all of our working capital line items on the balance sheet with a very simple percentage of sales. So that is the same. We varied a lot of those with revenue, i.e. sales. Property, plant and equipment, that's gonna change very little year to year. Company like Procter & Gamble has warehouses all over the world, manufacturing facilities all over the world. Their property, plant and equipment number is in the tens, hundreds of billions of dollars. So whatever it was last year, it'll be pretty close to what it was this year. Now, they're investing every year. They might build one new facility. So over time, if you look at it on a trend line, you'll see that number go up. So we want to forecast it to go up. But remember, the concept of precision here, this is not a make or break category. None of these are make or break categories. So don't stress out. Property, plant, equipment, we're going to increase that by estimated CapEx. Procter & Gamble gave us an estimated CapEx number, so yay, easy, let's use that. We don't have an estimate, we can look at depreciation, look at that as a proxy. If you're using straight line depreciation, those two should be pretty close. If you're using an accelerated depreciation, you might have to make a little bit of an adjustment, judgment call. So that's property, plant, equipment. Intangible assets, sometimes those have amortization expense associated with them. If they do, then we just have to look at last year's expense and subtract something similar. Current long-term debt, so for current debt, we're gonna assume that's paid off if the company doesn't go broke. They're gonna pay off their current debt. And then you'll recall that current was anything shorter than X. Shorter than how long? You remember? Anything shorter than how long is current? 12 months, you got it. Yep, anything shorter than 12 months is current. So the current is going away because we paid that off. But next year, we're gonna have a portion of our long-term debt that's not long-term anymore, because now it's coming due. So we have to take whatever that portion was and promote it, that now becomes current. And let's say that long-term debt was 10 billion and 1 billion becomes current, so now we have 9 billion in long-term debt. That's how that would be. So current gets paid off, some portion of long-term gets promoted to current. Long-term gets adjusted, and now you have all those forecasts. Lastly, stockholders' equity. Stockholders' equity won't change except for retained earnings. Retained earnings flow in from the income statement at income. Unless we have treasury stock transactions. And this can get very, very challenging because you'll recall that that treasury stock is often a mechanism by which management will manage all of their incentive comp. So if we have incentive comp going out in the form of stock options to employees, that's 10, 20, $30 million a year. Oftentimes the management will go out and buy treasury stock so that they don't dilute their shareholder base. If there's a program like that in place, you're gonna need to factor it in. You're gonna need to factor it into your analysis and buy back some treasury stock. Forecast that treasury stock out into the future, and then how's that gonna get reconciled on the balance sheet? With the cash flow. So now we've worked our way all the way down from assets to liabilities to equities. After we forecast the treasury stock and retained earnings, which is an easy one, we circle all the way back up top to cash and whatever number needs to make the balance sheet balance. Oh, that's our cash forecast. That's the residual of all the other forecasts that we've just made. What questions do you have for me on slide 21? That's a dense slide. I shared that slide of the income statement with explanations. Star that one and star this one.
Same as short-term debt.
Well, current debt is the same as short-term debt, yes. Yeah, under 12 months. Yeah.
So, I think, yeah. So it has, actually like, how it's like, whatever's left, you can assume that it's going to be in that. Whatever's left,
Yeah, so like with that, the net income flows into equity from the income statement. And if everything else on the balance sheet were identical, then our cash account would increase by that. So if we made out of a round number, if we made $1 billion last year, then $1 billion in income would flow through to retained earnings. So retained earnings would increase by $1 billion. So that's our equity. Well, in order for assets to equal liabilities plus equity, cash would have to go up by $1 billion too. It's exactly what you would expect. We just made $1 billion. It shows our income statement that we made $1 billion. That flows through to the equity section, and then cash becomes a flow. Okay, and it would be just that simple if the rest of the balance sheet didn't change. But now let's look at debt. So we pay off some debt. The debt number goes down. That has to come from cash. So when we circle back around at the end of this exercise and adjust cash, okay, yeah, you got it. It went up by $1 billion with net income, and it went down by the amount that we reconciled for current debt. And if you go through that process and think about it that way, with every line item on the balance sheet, you're gonna see, oh, okay, yeah, cash would have to go up with this reconciliation, and it would have to go down with that reconciliation, which is why we can use it as a fund. But that's a great question. It's not intuitive when you go through that cash is just a plug. Well, how does that work? Is there some kind of magic that ends up with cash always being a plug? Yeah, kind of, but you got to take it one line item at a time to recognize what's going on there. So that's a good question. Thanks for asking. Here's an example of the CapEx guidance that Procter & Gamble gives us. They say that in 2023, CapEx is expected to be 5% of sales. Great. Anything linked to sales makes our life easy. What I wanted to point out on this slide were the bottom three bullets, which is, if Procter & Gamble hadn't just told us that CapEx was going to be 5% of sales, where would we get that from? Well, we might look back at CapEx as a percent of sales historically. And if we did, we'd observe that historically, CapEx as a percent of sales was 3.9%. So in the absence of guidance, we should probably be using 3.9%. But Procter & Gamble has told us that their CapEx is going to be, well, let's see, if it's historically round up to 4, if it's historically 4 and they're going to spend 5 this year, that's a pretty big jump. 4 to 5 is a 25% increase in their capital expenditure. That's a big check for a company like Procter & Gamble that's going to spend $80 million on CapEx. That's an additional $20 million in CapEx over what you would consider to be their baseline. So that's interesting. That should spark all kinds of questions as an analyst. You should want to know, oh, that's pretty cool. Management thinks that they have investment opportunities that are worth writing a check for $20 million. Tell me all about them. What are those opportunities? Procter & Gamble's huge. They must have 200 different SKUs and business units that they could be investing in, and they're stroking a check that's 25% bigger than they usually are. There's probably something to get excited about in there and just ask the right questions. That could be an investable opportunity. Okay, depreciation's kind of the same way. We can look back at our historical rate. If we wanted to identify the historical rate of depreciation expense, we'd look at the current year depreciation expense. So just call it 2025 divided by the prior year property, plant, and equipment gross, or beginning of year 2025 gross, and that would give us our historical expense. And touched on that a bit earlier. Okay, intangible assets. Should be able to find a table that shows estimated amortization expense, or at least what it has been historically, and then you go through the same process as we just did for depreciation. Again, we're talking small dollars here, so don't get hung up on forecasting the pennies. There's no benefit in forecasting the pennies. Okay, dividends and retained earnings on slide number 29 here. For retained earnings, that's a function of your net income or net loss. For dividends, you're going to have guidance. You're likely going to have guidance. But for 27 and 28, that works. For 29, 30, and 31, you're going to want to look back at its historical dividend payout ratio. So the historical dividend payout ratio is going to tell you what percentage of a company's net income was paid out in dividends. The rest of it is what we call a retention ratio. So if we have $1 billion in earnings and we paid out $400 million in dividends, that's a 40% dividend payout rate. 60% of it we kept. So that's a 60% retention rate. And that one's not too challenging. So I'm hoping that as we go through these, most of this is fairly intuitive. You have the slides to come back to. Should be fairly easy to get a handle on where we've been. This is your forecasted financial statement balance sheet. So everything that we just talked about is right over here in this column. So start this, dog ear this. It'll give you a little bit of a reminder about how we went about forecasting working capital, intangibles, short-term debt, long-term debt, treasury stock, retained earnings, so on and so forth. Okay, let's move on to. There's a section in here on segment data, and I'm not going to spend much time on segment data because it doesn't apply to any of the companies that we're working on here. I think we get, for the most part, when I've seen segment data used in this capacity as a stock analyst, it triggers that precision threshold. We're trying to get a little bit too detailed when we use segment data. This would be more appropriate in a corporate finance environment where you have, for Procter & Gamble, a whole team of people working on beauty, or a whole team of people working on grooming, healthcare, fabric, baby and feminine and family care. You probably have staff of hundreds just in the corporate finance department supporting all of the various functions and properties and line items and SKUs associated with each of these categories. And they all do need good financial forecasts. So you can project hiring and investment, staffing, and so on and so forth. So I just want you to know that it exists. You can take a company like Procter & Gamble and break it down into basically 6 different units. And those 6 different units are 6 different companies in the world. And you can create 6 different forecasts. And then you can aggregate those up as the parent level forecast. And maybe you get a little bit of detail in that exercise that's helpful, but it's beyond the scope of this one. And I rarely see it, if ever, for stocking. I know with 100% certainty, this is a part of most corporate finance teams, but just know it's out there. This might be something that you're called on to produce one day if you're inside of a corporate finance department. Slide 38 is a great slide. It talks about sensitivity tests, and I want you all to do this. It's just such a great exercise for stress testing the key, most important assumptions embedded in your analysis. So with a stress test, you're asking yourself, okay, Procter & Gamble's guidance is for 0 to 2% growth, all in sales. Well, let's look at this through the lens of an optimist, and we'll call that the bull case. Let's look at it through the lens of a pessimist, and we'll call that the bear case. And then let's look right down the middle, and we'll just call that our base case. So our base case is probably just taking management at their word. Our bull case is, well, there's 1 or 2 different divisions, or there's 1 or 2 different opportunities, or we know there's $20 million in CapEx that they're spending this year that they weren't spending last year because they're excited about something. That's going to pay off for them, and their sales are going to grow at 3%. Well, let's make that our bull case. And not only do we factor in a 3% growth instead of a 2% growth, but with that 3% growth comes scale and a likely margin expansion from, I'm just making these numbers up, a likely margin expansion from 10% to 12%. And if both of those two things happen, we can forecast that out through our discounted cash flow analysis and calculate a price target of 205. Compare that to a base case where we're basically using management forecasts that gets us price target to 177, or a bear case where we come in at either the low end of growth, or maybe we hit some headwinds for one reason or another, and margins suffer, or there's some losses we have to write off. You be the judge of how you think that's going to unfold. That's a great analysis to go through. It really forces an understanding of what's going on inside the company and what could hit, or what risks could manifest in a really negative way. Okay, the statement of cash flows. There's no trick to forecasting the statement of cash flows. If you can create a cash flow statement, which you might have to take a little walk down memory lane to refresh yourself on how to create a cash flow statement. But basically, you're starting with net income. Net income is always the top line on the cash flow statement. And then you're reconciling net income for all of the non-cash items. So like depreciation expense is the same, reconciling item. Depreciation expense is not cash. So we reconcile for that on the statement of cash flow. And the reason I say that there's no trick to forecasting a statement of cash flows, because you've already forecast the income statement for 2027. You've already forecast the balance sheet for 2027. You have everything that you need to prepare a statement of cash flows for 2027, just like you would have if it were 2025, 2024, or 2023. Once you have those first two statements, the statement of cash flows is just piecing it all together. And you can see that here. So we start with net earnings. We reconcile for depreciation, which is an income statement item, amortization, which is an income statement item, any changes in balance sheet items, changes in accounts receivable, inventory, prepaid expenses, one by one. You just create the statement exactly like you would as if it wasn't even important. Then you move on to the investing section of the statement of cash flows, and you look for financing activities. So any new debt, dividends, change in short-term or long-term debt, purchase of treasuries, other financing, so on and so forth. I'm not too concerned about your ability to forecast a cash flow statement. I've never seen this done in practice. It's we just need to know how to do it. But then once you get out into the real world, especially if you're working for a mutual fund company or staff, I've just never seen it do.
Why is there more flashes? And then,
Like one of those.
yeah, with computations that are not meeting up to zero.
Well, let's see here. Fiscal year 2022 actual, fiscal year 2023 estimate. So that the actual change in accrued and other liabilities, I would say that was a zero, is what I'm guessing, was that was not a category on the 2022 actual statement of cash flows, or at least it's not reported here. But as you look out at the forecast, there is a change. So they take the 2023 number and subtract that from the 2022 number and get the change. But we don't have a change here. We're not looking at accounts payable. We're looking at the change in accounts payable. So if accounts payable is, I don't know, 14, whatever. If accounts payable is 15,000 last year, or 15,000 this year, then that would show up as a zero. It's a good question. Those dashes do look a little bizarre, but we don't have enough information to validate that there was no change. We'd have to go back and look at 2021 actuals to know that. So I'm guessing a little bit here, but I think that's right. Okay, let's look at preparing multi-year financials. And the process is going to be identical. We just have less information. So we're going to look at longer term growth rates. So for Procter and Gamble, we have 5-year average growth rates for each of the major lines. But let's look at the total company. Procter and Gamble has grown at a 5-year growth rate of 4.98%. And it's just that simple. So once we get past management guidance, once we get past the next 2 years is really all we can have visibility into. After that, we're looking at long-term growth. What's the long-term growth rate for our industry? The long-term growth rate for ADM, they've been around for 40 years, so they're going to be growing at long-term growth rate. Procter and Gamble, same way. Again, that's why I had everybody select from this list that did aristocrats, because the forecasting is, I'm not gonna call it easy, but it lends itself to conventional methodology. You know, now try to do the same thing for Google or NVIDIA or Broadcom or anybody that's involved in the hyperscaler AI supply chain. You know, I looked at a little chart today that showed maybe 15 different industries. And when artificial intelligence would probably overtake that 15. And the farthest one out were military robots by 2033. Well, can't forecast that. I mean, great. But if that's true, then there is no such thing as a forecast beyond 2 years, because the world is changing at a rate that nobody is smart enough to. Maybe I don't know. And that's one of the reasons why I gave you all that prompt that I uncovered last week. So at any rate, look at long-term growth rates, solve for revenue first, and then go through line item by line item to make sure that all of the forecasting techniques that we used for next year still apply in the out years. And basically, we're comparing all those different ratios to long-term historical averages. Okay, and then I talked about the parsimonious method, which is my favorite method, because all it requires is sales growth and margins. If you know sales growth and you know profit margin, you know profit. And if you know profit, then you can create a discounted cash flow. So use that Excel file that's out there on Canvas and begin to pull together these financial statements, and let me know if you find yourselves in any trouble, but I'm hopeful that that will be no problemo for anybody in this class to pull together some forecasts. Now, next week, we're going to talk about some multiple analysis. So price to earnings, price to cash flow, price to revenues. We're going to look at peer groups. We're going to look at historical averages. That'll be week 12. After week 12, we're going to take test number 3. After test number 3, you're done with the semester, except for this research project. So we'll spend the last 3 weeks of class and just workshopping stuff. So make sure that you have access to all the materials that we reviewed, investor relations, that prompt analysis from Claude. Start gathering everything that you need for that research paper. And a month from now, you all will be certified manual, or pretty darn close to it.
You were saying that we might have to add or just add some things onto the net income, and we're using the Excel. Does that mean we would have to go in and tweak with some of the formulas as well? Let's say cost of goods sold, we have to subtract that from.
Yeah, you have to monkey around with it a little bit.
Okay.
Yeah, all right. If you look at the formulas, they're not very complex. So.
Okay.
All right, thank you, gang. Appreciate your time tonight. I'll see you next time. Thanks, Zim Crew.
When you say you see us next time, we are. Or we.
I think so. I'm gonna send out a notice. Yeah, it goes every other week, so
Okay.
I'll send out a link to the lecture. No apology necessary.